All right. Weekly update. This week, I'm stoked to have the beautiful Rachael Drummond with me. She's with Bison Ventures.
Hi there.
Yeah, she's our resident loan officer. Well, not resident because you're really not in office, but you're around.
Yeah, I'm around. Nice. I'm easily reachable.
Yeah, nice. I like that.
There you go.
Cool. Rach was going to bring some stats because I think it was helpful when it comes to what's going on the mortgage side. I wanted to pick up quickly where I'd left off when it comes to the apartment side of things and how that's looking and how that could potentially affect us as well. Cool.
Great.
You want to jump into yours?
Yeah. Week over week right now, mortgage applications are up, so that's good.
That's good.
Yes, by 7%.
Okay.
This week compared to last week.
So when mortgage applications are up, what does that tell you?
People are consumer confidence, right? Consumers are feeling a little bit more confident with financing.
Okay.
But
yeah,
35% of all applications right now, guess what they are?
FHA.
Refinance.
Oh, really? Okay, so when you say 7% up, you're talking
that includes everything.
Refis.
That is all applications for financing.
Interesting.
They're up by
How did I not
they're
ever
up.
know that?
I don't know.
Yeah, I don't.
But that includes it means all mortgage loan applications, and that includes refinances.
All applications. Okay, so 25. You said 20.
35%.
35% are refis.
Right.
What?
I know. That's the initial reaction of like, how is that even possible?
Does that include commercial as well?
No, I'm talking just residential.
Oh, wow. Mm-hmm. Okay.
Yeah, I don't have numbers on commercial, but on the residential side, 35% being refinances, and you think like, holy crap, like that's insane, right?
Yeah, that's insane.
But right now, like the statistics of consumer debt is what's insane.
Oh, that's it.
Right.
People are trying to figure a way to get out of debt, so they're leveraging in their properties.
Yeah.
That's not a good sign.
And guess what else they're doing?
That's not a good sign. Okay.
What they're also doing is they're rehabbing the space that they live in because they're just not seeing, okay, rates are, let's call it 7.125 or 6.875 for a 30-year fix to 7.125.
7.125%.
And you can get lower if you want to buy some points, but most clients right now are not.
That's the range right now.
That's a good range, okay? At that range, a lot of them are looking at their current mortgage saying, wait, I'm at 2.875 or I'm at 2.99% because I refied in 2020 or 2021.
Yeah.
Even for the same exact mortgage amount that they currently have, increasing that by 5% or 4% in some cases. I mean, we're not talking just about like affordability right now. Like that's A, unaffordable for most consumers, and B, just totally unreasonable because they're not going to get the same property for that same amount right now.
Right.
So what they're doing is rehabbing what they've got.
Yeah.
They're making what they've got. They can do that for a lot cheaper. And when I say refinancing, that means home equity lines of credit as well. So not just necessarily, most aren't touching their first.
Oh, that includes home lines of credit too.
Yep, all applications, and that falls in with it. So,
so that 35% is probably all HELOCs.
HELOCs. They're paying off consumer debt, credit card debt, and they're financing pools or they're financing home gyms or remodeling their kitchen.
So that's just across the board.
It's cheaper across the board.
Okay.
It's way cheap. But even if it was just consumer debt, it is so much cheaper to refinance even their mortgage. And I hate saying this, but taking that mortgage now into a 7% loan, wrapping in 30 grand of credit card debt or 50 grand of credit card debt or student loans that are at a 27% interest rate into now that 7% interest rate, it is cheaper.
No way.
The numbers totally line up. They totally line up. Oh my gosh,
I would love to see how you math that out.
I will math it and I'll send it over. I have a mortgage coach analysis that I could show you on that. The amount of savings in interest over time is substantial.
As soon as you refinance on a 30-year mortgage at a 7% versus a 2.5%,
I don't recommend it. That's why I say get a HELOC all day.
HELOC is a better idea. But when somebody's refinance, wow, I would love for you to prove me wrong.
But the HELOCs are still trading at 9% because it's prime plus the bank rate. And right now, prime is at 7.75.
Yeah.
The bank rates right now are anywhere between 1.1 to 1.4, depending on what bank you use. So it's always going to be prime plus that bank rate. So even the HELOCs, people who are rolling money into a home equity line of credit, they're getting that around 9%, 9 to 9.2, let's call it, okay?
Wow.
right? Plus fees around $6,000, $5,000 in fees that are out of pocket. But what they're rolling into that, right? They're rolling high interest consumer debt into that, or student loans that have now become due because so long those student loans were in deferment. They're not in deferment anymore. Right? So those consumers who have been able to save for the last 3 to 4 years on student loans, they don't really have that money now. All of a sudden, they have to rebudget for that $250 to $600 a month student loan payment. No, they can't. But they've bought a home, so it is a phenomenal way to reconsolidate that debt. However, here's the thing. One of the greatest things about a home equity line of credit is the payment on that. It's going to flux with prime.
Okay.
And prime's supposed to go down 3 times this year. Now, obviously,
prime's at what, like 5.5 right now?
7.75.
Oh, the prime rate.
Prime rate. So it's always how that's calculated is the prime rate plus the bank rate gives you your interest rate on a home equity line of credit.
Got it. Okay.
But that'll go down. But it can go back up, right? Prime's high right now.
But you can pay off a HELOC pretty quickly.
And you get to keep that. It's a home equity line of credit.
Yeah, like those are helpful.
They are.
That was done, like we have used those in the past for pulling equity out and buying real estate with those, because also instead of like a credit card, the interest you can write off for tax purposes. So
the
that's
interest
where
is you can write off that interest, and now you're taking that combined interest of 27 to 30% down to 9 temporarily. That when as prime continues to tick down over the next year to 2 years, that payment's going to go down as well. But that line of credit will always be there, and consumers can continue to use that line of credit for additional purposes. We have a lot of clients that use those for...
It's a cool home hack.
Home hack.
Yeah, that's a cool home hack. I remember back in the day, I don't know if it's like Harry Dent. It was one of those books like the Roaring 2000s, or one of those back in the day talked about the that principle. And for those of us that bought back in the that was leveraged a lot. Like that was how I bought my first property was my first investment property was with leverage from a HELOC.
Right.
Knowing what I know now, I would still use it.
Yeah. Oh yes. Yeah. It's beautiful for anybody, whether you're a seasoned investor or a first-time home buyer. And the reason why is because let's take a first-time home buyer, for example. They get into a property, call it 5 or 10% down. Okay. And they're in this property, and they brought, let's call it $40,000 to the table. Okay. Right. And over the next 5 or so years, they've got appreciation now, and they can draw from that appreciation on a home equity line of credit and reinvest that money into another property. So their initial investment, now they've got 2 properties worth who knows what, right? Yeah. Depends. But those 2 properties, their initial investment was only $40,000. So a lot of people use it as a way to build wealth, as you know. But
thank you for bringing that.
Yeah.
Just to stay on topic really quick then. What are we seeing? So supply on the resale market is down 32% over what we say is normal. What did you call normal here, though? So normal is that last year's numbers, 32% off from last year. I think that what this number is, when it comes to the supply being at 32% less, it's what can the market support. So ultimately, we've got this supply that's 32% less than what an even keel would be from supply and demand. The struggle with supply and demand right now is that we've got demand that is absolutely sticking to certain levels of house here in the valley. The $1 million to $2 million houses right now seem to be flying, which is
stats on that are really good too.
Yeah,
we've got those. We can share them.
So we don't have enough time in this video, but we can. Let me just get really quick to the apartment stuff. So in the apartment things, we've got. Based on the feedback that I had in the last 2 videos, we had the Zumper data. So Zumper is this tool that is used for apartment renting. And why that's important is because right now there's this huge surge, and I think nationwide, this big surge of increasing multifamily. And everywhere you look out here, there are multifamily properties being built everywhere. So when you look at the data, when you talk to people who are living in those spaces, a lot of them will tell you it's like people are moving out. Yeah, rents are coming down. All right, so what is Zumper saying? This is super, super, super interesting because this affects us on the resale or on the residential side. They're talking about Phoenix from last year to this year, rents have come down on Zumper in Phoenix by 16%. Downtown Phoenix, the properties that are being built in downtown Phoenix have come down by 9%. And Scottsdale, listen to this, Scottsdale has come down by 24%. So the values are just dropping. And if you have multifamily, it's a really good idea to be paying attention to these numbers so you know where to price, you know what those pressures are and why maybe you're not getting the rents that you thought you should be, or what's going on with this in the market. It's like, dang, we don't have apartment data. Zumper is great for apartment data, but we don't see that stuff, right? This was something that was put out this week. So it's like,
what is going into that? Like, why are those numbers? Why are those? I mean, that's all across the board. They're down.
I don't have the answer, but what I would speculate is that there's just oversupply. And I mean, there's 20,000 more units scheduled to come online this year in 2024, right? 20,000 more here. And with that, what's going to happen to these prices and how is that going to affect us on the long-term hold side for properties in particular neighborhoods that have a ton of these coming online? Is that affecting our numbers on the residential side?
Yeah.
Probably, right? By how much? Not sure. It's a different type of person that's going to live in the apartments versus moving into one of our homes. However, we do have properties that are multifamily. We've seen similar pressures, right?
Wow.
It's just until you see the numbers, it's like, okay, like this isn't just our thing. This is the thing.
Yeah.
And it's like we have to be able to pay attention to it. We don't do enough multifamily to where it's in our peripherals, right? It's more so only when that shines itself like that.
Yeah. And I feel like, and this is just an observation,
Yeah.
that they're not, all of those new starts that are happening, they're not building for who's here because they wouldn't be building based on these numbers, right? They're building for who's coming.
But also, you got to think about the life cycle of what's being built. If a property's coming online this year, how long ago did they get started?
Yes.
Yeah. So like the one right down the street here called the Governor, that one was, we were talking about that thing 5 years ago.
Yeah.
Right? So think about that life cycle of how long it takes to get everything moving forward and what does that really take? So opportunities for those of you with, tens of millions of dollars in your pocket ready to pick up some assets. I'm sure that time is coming sooner than later, unfortunately. It's like, I think a lot of these investors get into these properties and they're hopeful that the rents are going to support. I just think it's a totally different level. Like I don't know enough about it. But cool. Thank you so much for watching.
Thanks for having me.
Yeah, absolutely. Thanks, babe.
Have a great day.
Yeah. Subscribe if you haven't. And I will see you next week. Cool. Wow, that's long. 13 minutes. Damn.